Before you drop hundreds of thousands of dollars on your first investment property, there's one equation that separates profitable investors from those who lose money every month. I've seen too many first-time investors in San Antonio skip this step, and it costs them. So I'm walking you through the exact formula commercial investors use, and by the end, you'll know if your property is actually going to make you money. Okay, so the first step before you even think about investing in anything is going to be determining your own risk tolerance. Now, this is a conversation that you probably should have already had before you get to this video, looking for how to do the math. The risk versus reward graph looks like this, right? Exactly like this. The higher the risk, the greater potential for reward. That's the main word that people miss when talking about investing. They hear the greater the risk, the greater the reward. No, the greater the risk, the greater potential for reward, because there's still the chance that you lose, right? So you have down here at 0, this is where you have people who do savings accounts. Not very much risk, little to no reward, right? Might get like a penny every now and then from sticking your money in savings accounts. Then you have things like stocks and bonds. They start to go a little bit higher. Then you have things like real estate. As you can see, real estate is a little bit higher on that risk versus reward situation than your stocks and bonds. It's definitely higher than your savings. Much, much lower, though, than, say, taking a trip to Vegas. Okay, so that's kind of your max out of risk versus reward ratio. You can have the potential to do some crazy gains in Vegas, but you also have great potential to lose everything. So you have to have a conversation with yourself on how comfortable you are here. Or is it going to be worth the risk to you? That's something I can't really help you with. That's going to be based on your life experiences and who you are as a person. So have that inner monologue before you get started on trying to do any math. Okay, so your first math problem is a rather simple one. It's going to be your income minus your expense equals your net operating income. So that's how you get how much you net, which is the actual amount that's going to go in your pocket, right? So we're taking the full amount that you're bringing in, minusing the expenses, and getting your net operating income, or NOI. Okay, so in this example, we're going to make a lot of assumptions. So we are going to start out by saying we are going to buy an 8-plex that is going to have the gross potential for income to be $144,000, right? And how you would figure that up is by calculating how much rent you're going to be able to bring in for that 8-plex within 1 year. So that's your gross potential in 1 year. So we're going to say that in all 8 units, you'll be able to collect $144,000 in a year in rent. Okay? So now you have to subtract your vacancy rates. So we're going to say that you have a 10% vacancy rate. So we're going to subtract 10%, which for this equation, that means it's $14,400. So we're going to subtract $14,400, or if you're using a calculator, you can literally do 144,000 minus 10% sign. But once you do that, then we're looking at, you can go ahead and do it, follow along. I suggest you follow along. Okay, so this is what we're working with right now. So that 10% was your vacancy. and that means the $129,600 is your income. That's the full amount of your income for the year. But wait, there's more. Now you have to factor in any and all costs associated with the property. So this could be landscaping if you're going to pay for landscaping services. It could be, it's definitely insurance on the property, right? Because you're going to want insurance on your property. Any other kind of maintenance that your property may need, utilities, if you're going to cover any of the utilities, which you will have to do if you have a vacancy. You'll have to cover the utilities in the vacancy. Taxes, any admin, if you hire a property manager, all of those things. So let me just go ahead and list those things out. So insurance, maintenance, landscaping. So when you're actually doing this, you'll want to get as close as you can, right? So you want to try to find out all of this information down to the actual numbers, add them all up. Marketing could be marketing on advertising the property in order to get renters into it. You'll want to find out these exact numbers as close as you could, write them all out, add them all up, and use that. But for this instance, since we're just making up a scenario, a good rough estimate is to say that these things will cost you anywhere between 40 and 55% of your income. So now, and I know some people you're probably thinking, oh, well, what if I just do some of that stuff myself? Like, what if I just take care of it and then there's no cost associated with it because I'm doing it? Wrong. Time is your most valuable resource. Time is all of our most expensive currency. So factor that in. Factor that in as a cost, even if you're doing it yourself and you think that's considered free. It's not free. You're costing your time. So factor that in. So we're gonna just boop, 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 and say, so 40, anywhere between 40 and 55% roughly is what we're looking at for that. I'm just going to go somewhere in the middle and I'm going to use 48%. So I'm going to say we are going to subtract 48% for cost of all of these things. And now we have $67,392, and that is our net operating income. See that there? That's how we come up with what our net operating income is. Now, we've subtracted all of our expenses. The next step of our math equation is our NOI divided by the cap rate, and that's going to give us the value or the amount that we should offer on the property. This property is for sale. We're thinking about buying it. We're going to decide whether we should buy it based on whether or not it's going to be profitable for us. And we're going to decide on the amount that we should offer for the property. That's what we're doing in this equation. So now you're probably thinking, what is cap rate? It stands for capitalization rate, and it is your rate of return on the property. So if you're doing the equation this way, you make up that number based on what you want to make. Like, what is the amount of money that you want to make? What is the percentage, your rate on return that you want? And if you're doing it this way, you're assuming that you're going to pay cash for this property. It's based on you having the full amount up front. You're going to hand it over. You're not doing a loan. You're doing it this way. You're going to pay cash. You're going to determine your rate of return. That's your capitalization rate, and you're going to do this math. Now let's just say you have decided you want your cap rate to be 8%. So we're going to do your net operating income which is that number that we just found, 67,392. We're going to divide that by 8%, and that's going to give us, see, your cap rate is 8%, that's going to give us $842,400. So that tells you if you're going to pay cash for this property and you need an 8% return, this is the amount. You would not want to pay more for the property than this. You'd have to pay this amount for the property in order to get an 8% return on this 8-plex because of the amount of rent and how much you are set to profit from it. Now again, this is assuming a cash buy. And as a realtor, there's also another process that we go by to determine the market value of the property, and I would do that for you as well, and then you can compare what it's selling for, what the market value of the property is versus that amount. So the seller is going to want close to the market value or the market value in order to sell that property, and you have to determine whether this amount is accurate compared to the market analysis, and then that's where negotiations happen. Now let's say you weren't going to do a cash buy, you were going to leverage other people's money, meaning you're going to get a loan from the bank and purchase this property, finance it, right? So you're going to finance this property. So the purchase price, I'm going to say you decided you're going to offer that purchase price of $842,400. That's the purchase price. Now you're going to do, for a conventional loan, we're going to put 20% down. You can buy investment properties with FHA or VA, but you have to live in those properties for those loans. So you have to keep in mind and set aside one unit you're going to be living in, and it's not going to be income producing. You'll technically be saving money on the cost of housing because you're going to be living in your unit, but just that's something you'll have to factor in and keep in mind. For this example, we're going to pretend that you're not going to live in it. It's just straight up an investment property, and we're going to do 20% down and an 80% loan amount. So you're going to do 80% for the loan, which comes out to $673,920 that you're going to take a loan out on. And then your 20%, which is also called, it'll be your down payment, but it's also called your equity in the investment. So you're putting the equity you're putting down, your down payment, 20% is $168,480. Okay, so you can see those numbers there. And we're gonna assume we're just gonna say we're gonna have a 6.5% interest rate. And we're gonna say that it's a 30-year loan. All right, so now you need one extra number, and that's going to be your P&I, or your principal and interest. And so this isn't something you can just calculate on a whim, because interest rates are always moving, right? They're always doing things. So this is something that you will have to reach out to a lender or your realtor who has the ability to calculate that for you. So that's something you're going to have to ask for. In this case, we're going to say that your P&I, your principal and interest, equals $4,259 a month. So that's your monthly P&I. Now we're looking for numbers for 1 year. So we need to multiply that by 12 months. and that's going to give you 51,108. So $51,108. Now that equals your ADS, which stands for your annual debt service, which means this is how much you're going to have to pay to the loan in 1 year. Your annual debt service. So now you want to find out how much you'll cash flow whenever you take out this loan for this amount and you have this annual debt service. How much am I going to cash flow from purchasing this property with this loan? So how you figure that out is you take your NOI minus your ADS, and that equals your cash flow. So NOI minus your ADS equals your cash flow. So in this case, that was this number that we found up here, your NOI. Your net operating income was $67,392, and you're going to subtract your ADS, which you just found out was $51,108, and that is going to give you a cash flow of $16,284 for the year. So you're going to cash flow, you're going to pocket $16,284 for the year on that property. Now, if you want to find out your return on what you put in, so your cash on cash, you might have heard that phrase before, your rate on return. So earlier we did the equation a little differently where we were factoring in a cash buy, and we used the rate of return we wanted to find out how much we were going to buy the property for. In this case, we're using a loan, and we're going to use this math to determine what exactly our rate of return is. In order to do that, you take your cash flow, what we just figured out, the $16,284. So we're going to put that down here, $16,284. And you divide it by your equity. So let me write out cash flow divided by equity. Now remember, your equity in this instance is the same thing as your down payment, for terminology's sake. So we're going to divide that by, we're going to divide your cash flow by your equity, and we're going to go back up here. What did we say we were going to put down? 20%, which was $168,480. And then once you do that math in the calculator, it will give you a cash on cash rate of return of roughly 9.7%. So there we go. So this is what we call using positive leverage. We're leveraging other people's money, borrowing from the bank in order to create income, your own personal income, at roughly a rate of return of 9.7% in this case. All right, so that's the math you need to do every single property before you decide on purchasing it or looking into it and seeing if it is going to be a good deal for you. If you'd like, there is going to be a link down below where I'm going to type out each of these like equations so you can have it on you, clicking it, keep it. That'll probably be easier than going back and pausing this video when I'm like flashing it to you. So you'll have that. Run through this video a couple of times, pull up a couple examples, and practice, 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 and do not even think about purchasing a property until you've done this math. All right. I'm Jenna Pignataro. If you're interested in buying a multifamily property in San Antonio, Bexar County, you can reach out to me and I'll be happy to help you do that. There's another link down below if you would like to schedule a one-on-one consultation. Thank you, and I'm wishing you the best of luck in your investment journey.